So have you ever logged into your brokerage account and just seen one of your stocks take a huge hit overnight for like no apparent reason? It's a horrible feeling, right? But a lot of the time, the answer isn't some big market crash. It's something called a rights offering. And today, we're going to break down exactly what's going on with your money.
Okay, so here's what we're going to cover. First, we'll tackle that mysterious price drop. Then, we'll get into what a rights offering actually is. We'll do the math together to see how the new price is calculated and figure out what a right is even worth. Finally, we'll look at the two choices you have as an investor. And trust me, by the end of this, it'll all make perfect sense.
All right, first up, the price drop mystery. Let's get right into it. So picture this, right? You're an investor, you check your portfolio, and bam, one of your stocks has just plummeted overnight. The immediate question, the one that makes your stomach drop, is, have I lost money? And yeah, your first instinct is probably to panic, but the real story here is way more interesting and thankfully a lot less scary. Just look at this. Yesterday, the stock was trading at a solid 20 shekels. Today, it's down to 17.60. I mean, that's a pretty big drop. But here's the thing, and this is the most important part. You're not actually losing value here. What's happening is a reallocation of value, and it's all because of this rights offering.
So what in the world is this thing that's causing the price to change so predictably? Let's decode the corporate action that's really behind all of this.
Okay, so a rights offering. What is it? Basically, it's the company's way of saying thank you to its current shareholders. It's an invitation just for them to buy more shares. And here's the kicker, usually at a pretty sweet discount to the market price. It's how a company can raise some cash without making its existing investors feel like their piece of the pie is getting smaller.
Now, the details are everything. In our example, for every 4 shares you already own, you get 1 right. And that single right lets you buy 1 brand new share for only 8 shekels. I mean, compare that to the 20 shekel price from yesterday. That's a huge discount. And these numbers, they're the key to everything we're about to calculate.
Okay, let's get into the math. Don't worry, it's simpler than it looks. We're just going to figure out how the market takes all this information, the old price, the new cheap shares, and spits out a new, fair price for the stock.
Now, you might see this formula and your eyes might glaze over, but hang with me. The idea behind it is super simple. It's really just a weighted average. All we're doing is blending the value of the old shares with the value of the new shares to find the new average price per share. That's it.
Let's walk through it step by step. You've got your 4 old shares, right? At 20 shekels each, that's 80 shekels of value. Now, add in the 1 new share you get to buy for just 8 shekels. So 80 plus 8, that gives us a new total value of 88 shekels. But now, instead of 4 shares, you have 5. See where this is going?
And voila, 88 shekels divided by 5 shares gives you 17.60. Exactly. So that big scary price drop, it wasn't random market chaos, it was pure, predictable math. No money just vanished into thin air.
Okay, this is so important. The value didn't just disappear from your stock price. It had to go somewhere, right? Well, it did. It moved right into that right the company just handed you.
I mean, just think about it for a second. The company basically gave you a special coupon. This coupon lets you buy something that's worth 17.60 on the open market for only 8 shekels. That coupon itself has to be worth something, right? It's worth the difference.
And the math here is just so simple and elegant. You take the new market price, the 17.60, and you subtract this special discounted price you get to pay, which is 8. The value of your right is literally the discount you're getting.
And there you have it, 9 shekels and 60 agorot. That's what each right is worth. It's a real tradable asset. So you see, the value didn't just poof disappear from your stock. It just changed its clothes and showed up as this new thing you now own.
All right, theory is great, but let's make this real. Let's follow an investor and see exactly what this looks like in a real portfolio. They've got 2 clear choices ahead of them.
So here's our investor's situation before any of this happened. They own 8,000 shares. The price was 20 shekels a share, so their total portfolio value was 160,000 shekels. Okay? Remember that number, 160,000. Okay, so now the offering happens. They've got 8,000 shares, and remember the ratio was 4-to-1, so that means they've just been given 2,000 rights. Now comes the big decision. What do? Do they sell those 2,000 rights and just take the cash, or do they use them to double down and buy 2,000 new shares at that cheap price?
Let's explore option 1, sell the rights. Okay, so their original 8,000 shares are now worth less, right? The total is down to about 140,800 shekels. Bummer. But wait, they sell their 2,000 rights, and that puts a cool 19,200 shekels of cash right back into their pocket. So you add the new value of the stock to the cash from the rights, and what do you get? 160,000 shekels. Exactly what they started with. Their net worth hasn't changed one bit.
All right, now for option 2, exercise the rights. This is for the investor who wants to increase their stake. They take 16,000 shekels of their own cash and buy those 2,000 new shares. So what's their portfolio worth now? Well, it's the original 160,000 plus the new 16,000 they just put in, for a grand total of 176,000, which, if you do the math, is exactly what 10,000 shares at the new price of 1760 is worth. Again, the math checks out perfectly.
So we've been through all the numbers, all the choices. What's the big takeaway here? Let's do the final tally.
You know, there's that old saying in economics, there are no free lunches. And this is a perfect example. A rights offering doesn't magically print money out of thin air, and it doesn't make it vanish either. It just moves it around. It's the market being perfectly mathematically efficient. So, here's what I really want you to walk away with. A rights offering is a reallocation. It's not a loss. That drop you see in your stock price is perfectly balanced out by the value of the rights you just received. Your total wealth is completely safe whether you sell the rights or exercise them. The only real question you have to answer for yourself is, do you want to put more money into this company, or would you rather take some cash off the table? That's your call.
And that really makes you think, doesn't it? A rights offering is just one kind of corporate action. You've got stock splits, spin-offs, special dividends, all sorts of things that can make your portfolio look completely different overnight. But when you understand the mechanics behind them, you're no longer just watching and worrying. You're an informed investor, and that makes all the difference.